morning, good afternoon, good evening, traders from across the globe. Welcome to Short-Term Trading Live with Oscar. Traders, this video is being filmed on Wednesday night for Thursday's trading. That's August 6, 2009. And I am here to say a couple of things. One, 30-year T-bonds, another red arrow. We expect bonds to go down again. I will show you that the bonds seem to be affected by the Emini proprietary moving average. Every time the bonds seem to hit it, a steep drop ensues, and I'll show you that chart. I am also here to say that we are still buyers of dips in the S&P, Nasdaq, Dow Jones Transportation Average, and other indices. There is a possibility of a pullback coming tomorrow on Thursday, so we will start off with a neutral posture. Let the markets come down to an Omni sweet spot and then move in and see what happens. Of course, no matter what happens, we always have stops in because a stop is your best friend. Never trade without them. But to reiterate once again, we're selling a rally in bonds. We're buying dips in in indices. And that's only if it dips deep enough to set up for an Omni buy area. Now, traders, 5 minutes before I was about to film this video for you, I was in my chat rooms and a few of my European traders said, Oscar, I just woke up to some tremendous newspapers. And before I tell you about those newspapers quickly, I wanted to say this. I have read news to you in the last 2 weekend webinars, and I've said to you the newspapers are really starting to look better. The outlook for the economy in the U.S. is starting to look better, right? And we've seen that for the last few weeks in U.S. newspapers. Well, here we go from the UK, traders. Some headlines. New hope that the UK is pulling out of recession. Headline in today's papers in London. Another one. The worst of the recession is over, according to leading UK forecaster. Boom, once again. Another headline. House prices boost the hopes of recovery. This is in London, traders. In Europe, you're starting to get headlines that now look like ours did a few weeks ago and still look like today. Looks like we're starting to pull out of this recession around the world. We've seen the Asian markets already go. The United States is on its way. Now we're starting to hear it out of Europe. Yeah, baby, yeah. What more can happen here? Now, traders, we are in the buyer of dip posture in the indices, and there is a new slogan on my board, and this is what I want you to keep in mind. Don't fall in love with the downside. From now on, when there are dips, don't start selling into them. Back off and buy them when the market seems to level off. What I'm trying to say is this, traders. In a bearish market, if this were a bearish market like the one we've seen between 2007 and 2009, you had to sell the rallies. Don't fall in love with the upside was on my board for the whole drop. And I said, no matter what you think, when this rallies, you got to sell those rallies. Don't try buying into it. Well, that has changed. It looks like since around March 2nd to March 6th of 2009, the indices in the United States have been just going higher and higher, a little bit of consolidation, then higher and higher. So the pullbacks now need to be purchased. Again, the point I want to make is this. When in a bull market, you should not be trying to sell a rally, waiting for it to dip so that you can finally get long. You should wait for the dip and then get long, and the only time selling should come out of you is when you're selling out of a long position. That will keep you on the right side of any of the big breakout moves when in a bull market. When trading in a bear market, you use the exact opposite posture. When the market rallies, you sell into it. Then when it drops, you buy them back. But you should never get caught holding longs in a bear. Well, when you are in a bull market and it's starting to really look like that's what we're in the S&P, yes, it can pull back. It can have two-day pullbacks. It can actually set back for $20, $30. But what you should be doing is looking at it as, where should I get long for the next haul higher when in a bull market? Again, bear markets, you sell rallies. The only time you buy is to take profits and or stops. In a bull market, you should be buying dips. The only thing you should be selling is either getting out of a position or getting hit on a sell stop. That will keep you on the correct side of the markets. Okay, traders, so S&P and Nasdaq, we are using the buyer of dips mentality. And the mentality I just explained to you is what you should be using if you are a professional trader and would like to stick around for a while in this industry. When in a bull, buy dips. When in a bear, sell rallies. All right, traders, so with the bonds being a short on a rally, I'm going to show you a chart for bonds right now. I'll show you a Nasdaq chart, and that's it. 2 baby charts, and we're out of here. Let's go to the charts, traders. Okay, traders, the chart before you right now is the U.S. 30-year T-bonds daily bar chart for September. Each one of these green lines represents 1 day's trading. As you can see clearly, the Emini proprietary moving average right here, every time the market hits it, a big drop ensues. Look, you hit it, major drop, rally didn't hit it, big drop, rally didn't hit it, and immediately started to go down, and we're here now. We are going to sell a rally expecting lower lows. We think we can get lower than the 115 lows we seen only a couple of weeks ago. But tomorrow's target is not quite that low. It's in the 115s, but not at 115. We will be selling rallies in this market, as you can clearly see once again. Failure at the Emini average, failure at the Emini average, failure at the Emini average. When you see that and your indicators are also pointing lower, basically you have a pretty good idea that the market will go lower, so you sell into something that looks like that. So that's the bonds, traders. Now I'm going to show you one chart only of the indices, and it is the Nasdaq. Okay, traders, we are looking at the Nasdaq September daily bar. Nasdaq, again, you've seen this chart on these videos, the last few videos, staying very smartly inside of a parallel channel. But we do have what's considered a flat top here in the Nasdaq. So flat tops will likely produce market drops, but we are in the beginning stages of a bull, and the last flat top right behind it ended up rallying the market, not dropping. So here we are with another flat top, and we can easily rally out of that one. However, we will be cautious at the opening and on the beginning of this day, and we'll wait for some sort of a pullback. And if it pulls back and holds, then we're going to buy it and look for a rally. And we have a trade set up on our site for bonds and for the Nasdaq. If you come on down to www.livewithoscar.com, you can see on the Emini page the Emini recommendations for both the 30-year bonds and the Nasdaq. In fact, we have recommendations in several other markets, but those are the ones that are posted for the public right now. Again, traders, there's really no reason for us to break hard because we are beginning to be in a bullish market, but flat tops do produce market drops, and that's something that I've lived by for quite some time. So I can't just buy into this tomorrow until I see a test of the downside, which holds support, and then I'll get long. Traders, pull your own charts, do your own homework. Make sure you can see the charts in the fashion we view them in, and if not, please come down to the Emini Trading Academy where we can help you with that sighting. So, traders, you saw that bond chart, and look, there was no arguing with that Emini average on that bond chart. You hit it and break. That's what seems to happen. We hit it just a couple of days ago and began to break, and I think we will break further. So we are going to sell the dips in the bonds. You see that flat top in the Nasdaq indicators are starting to point down. It's Thursday. Thursday can be a fickle day, so we're going to buy the pullback. We're not just going to get involved until the markets show us some support. All right, traders. Please give me a call anytime there tonight, 702-629-4755, and get yourselves down to the Emini Trading Academy. It's www.livewithoscar.com. Jump into the chat rooms. They are free. The open room is free for the public. There is nothing that you need to do to sign up except for create a username and jump on in and see what we're doing here, traders. We invite you to classes. We are here to help you. So don't trade alone. Come on down to the Emini Trading Academy. All right, traders, as I said, a stop is your best friend. Never trade without them. And try to keep your emotions out of trading because emotional decisions always turn out to be bad ones. One of the best things you can do to help yourself keep your emotions out of trading is to say this to yourselves every morning, every afternoon, every evening. And you know what that is? Stops are in. Emotions are
Futures trading is risky and can cause substantial financial loss. We do not claim or guarantee that you will profit from the information provided. That being said, I'm a 27-year seasoned trader on and off the trading floors. This is how I've made my living for many, many years.